In this video, I will share with you a well-guarded secret on how to successfully plan for rising healthcare costs in retirement. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Welcome back. Today, we're talking about a financial topic that everyone over 50 needs to face head-on: the brutal cost of long-term care. This isn't just about nursing homes. It's about needing help with daily tasks like dressing or bathing, whether at home or in a facility. This is the single largest financial threat to your retirement savings and the biggest potential burden on your children. The latest numbers are shocking. The average cost for a private room in a nursing home is now over $100,000 per year, and that number is rising. Most people think Medicare or health insurance will pay for this. They won't. Medicare does not cover long-term care. So what's the plan? We're breaking down the 3 paths people take and revealing the one smart strategy that protects your wealth and secures your dignity in retirement. Section A: the trap of waiting and the Medicaid myth. Before we jump into our 3 smart ways to pay, we have to talk about a huge trap that catches a lot of good people: waiting too long. People often tell themselves, "I'll deal with it later," or "my savings will be enough." But remember what we talked about, that huge cost, over $100,000 a year for some care? That cost is rising every single year. Planning for long-term care needs is not for tomorrow, it's for today. The other big mistake is thinking you can just use Medicaid for nursing home costs. Now, Medicaid is a great program, and it helps people who truly have nothing left. But here's the tough part. To qualify for Medicaid long-term care coverage, you usually have to be poor. The government makes you spend down almost all your savings first. Think of it like this. You have to spend your own money until you are nearly broke, and then the government steps in. You have worked too hard to have to spend down your assets for Medicaid eligibility. That's why proactive planning is the key to protecting your inheritance for your children and keeping your dignity. If you're worried about how to protect your house from nursing home costs, then a real plan is your only defense. The 5-year look-back rule for gifting money is a big deal here, and it's complicated. So a better solution is to find a way to pay that doesn't involve going broke first. That takes us back to our 3 main paths to cover those massive long-term care expenses. Section B: the 3 main ways to pay. There are only 3 ways you can pay that huge bill. Number 1, self-insure. This means you have enough cash sitting in the bank, maybe a few $100,000, that you are comfortable using to pay for your care. This is a great position to be in, but it does carry risk. The risk is that a long care event, say 5 or 6 years, could wipe out everything you saved for your kids. This is the ultimate use it or lose it scenario. Number 2, traditional long-term care insurance. This is a classic insurance model. You pay a monthly or yearly premium for decades. If you need care, it pays out. The biggest risk here is that the insurance company can raise your premium over time, making it unaffordable in your later years. If you stop paying, you lose everything you put in. It's a use it or lose it gamble. Number 3, the hybrid policy. The smart money strategy. This is the one that has become the clear favorite for modern retirement planning. It's a combination of life insurance and long-term care insurance. often called linked benefit life insurance. You pay a fixed amount, either one large premium or payments over 5 to 10 years, and you are guaranteed coverage. The benefits are dual. If you need long-term care benefits, it pays for your care. If you don't need care, the full death benefit still goes to your family tax-free. Your money is protected either way. It's an asset-based long-term care solution. Section C. Why hybrid is the smart money strategy? Deeper dive. I want to spend a little more time on why the hybrid policy is what experts call a smart money strategy for retirement health planning. It's not just a nice option. It's often the best asset-based long-term care solution available. First, let's talk about the money you pay in, called the premium. With the traditional policy, the insurance company can sometimes raise your monthly fee after you buy it. That's a nightmare when you're on a fixed retirement budget. But with a hybrid policy, your premiums are guaranteed to never increase. You pay the agreed-upon amount, either all at once or over a set number of years, and that's it. That certainty is worth its weight in gold for anyone doing guaranteed retirement income planning. Second, let's look at the tax side. The money that comes out of the policy to pay for your care is typically tax-free long-term care benefit payouts. That's huge. When you take money out of a retirement account like an IRA, you usually have to pay income tax on it. But when the hybrid policy pays for your care, that money is often free of income tax. This is one of the biggest benefits of tax-advantaged retirement health strategies. You get to keep more of your money working for you. Third, remember that life insurance, part of the hybrid policy, it means you are putting your money into something that has a floor. If you never use the care benefit, your family gets a check. Your money is working for you, not gambled. That assurance gives you true peace of mind for senior care planning. You are making sure your wealth is passed down, which is often called a legacy protection plan. This is how you ensure the financial legacy for your family remains strong. Section D. Care settings and crucial policy details. There are two main places people get long-term care: at home or in a facility. First, home health care services. This means a kind, trained helper comes to your house to assist with things like dressing, cooking, or managing medicines. Second is assisted living versus nursing home care. The key to effective senior care cost management is understanding the difference and planning for the cost of the higher level of care, just in case. Your long-term care policy can pay for either one. There are two critical policy details you must discuss with your advisor to ensure your plan actually works 20 years from now. First is the elimination period. Think of this as your time-based deductible. It's the number of days you must be receiving care before the policy starts paying. Common options are 0, 30, 60, or 90 days. During this time, you pay the cost of care out of pocket. A 90-day elimination period is popular because it lowers your premium, and many people have enough cash set aside to cover those first 3 months. But if you don't have that cash, you should choose a shorter period. This is vital for smart long-term care budgeting. Second, and perhaps the most important for anyone planning in their 50s or 60s, is the inflation protection rider. Remember that the average cost of care rises by about 3% to 5% every single year. A benefit that covers today's $100,000 cost will only cover about half of the cost in 20 years. An inflation rider is a benefit you add to your policy that automatically makes your daily payout grow every year. It's a way to ensure your long-term care benefit keeps pace with rising healthcare costs. Without a compound inflation feature, your future benefit is simply too small to be helpful, defeating the entire purpose of protecting your retirement nest egg. Make sure you ask your agent specifically about the compound inflation option. It's the difference between a policy that works and one that doesn't. Section E. Making the plan simple and actionable. Now that we know the 3 ways to pay, let's put it into a simple action plan for your long-term care planning. Remember, the best time to do this is when you are healthy, typically in your 50s or early 60s, because the less healthy you are, the more expensive it becomes. Action 1. Talk to an expert. You need to sit down with a professional who knows about these different types of policies. They can help you figure out how much care might cost where you live. You are looking for a plan, not a product. Action 2. Decide on your goal. Are you trying to cover all the costs, or just the main costs? Even a smaller hybrid policy is enough to protect your primary assets from healthcare expenses, like your home. Knowing your goal helps the expert find the right size policy for your budget. Action 3. Look at funding. This is important. If you decide on a hybrid policy, where does the money come from? Many people use old, traditional life insurance policies that they don't need anymore, or they use money that is just sitting in a savings account. You can use a special IRS rule called a 1035 exchange to move money from an old policy into a hybrid one, and you won't have to pay taxes on the move. This lets you turn a stagnant asset into a tax-protected care fund. That's a very smart way to leverage existing assets for long-term care funding. We've now covered the basics of long-term care insurance options for retirement. I want to highlight that this kind of financial preparation is about so much more than just money. It's about dignity in retirement and giving your family peace of mind. Without a solid plan for how to pay for skilled nursing care, you risk putting a huge burden on your kids, forcing them to become your caregivers or spend their inheritance to keep you comfortable. That's the real reason to investigate this now. You're not just buying insurance. You're buying a way to protect your family from financial burden. The high cost of senior living expenses should not be the reason your children go broke. When you ask your advisor about a hybrid policy, use the phrase linked benefit life insurance policy to sound smart and make sure they are talking about the right thing. The key takeaway today is that doing nothing is the most expensive plan of all. Take action today to ensure your financial security in later life. I hope this simple, straightforward conversation has helped you understand the critical steps you need to take right now to plan for retirement healthcare costs. This information is vital, and you don't want to miss our next video on healthcare and insurance planning. So, do yourself a huge favor. Subscribe right now so you don't miss our next value-packed video. Click the thumbs up button to give us a like for bringing you this vital free information. And please comment below saying, "I love this video." It helps us reach more people who need this essential knowledge. Thank you so much for joining me today. Remember, the information in this video is for equipping, educating, and empowering and is not professional advice. Please consult with a qualified financial advisor to create the plan that is right for you and your family. We'll see you next time.